Well, last week, the Federal Reserve was back in action, this time guiding interest rates higher by 0.25%. In this morning's U.S. Bank Economic 360, U.S. Bank Senior Vice President Mike Denneman joins Business Courier editor Rob Dahlmeyer in the studio to talk about the rate hike and what it means for the market. Rob and Mike.
Kelly, thank you so much. So, Mike, let's start simple. What happened?
Sure. So, as Kelly said, they guided rates higher by 0.25%. In technical terms, what the Fed did was adjust their range for federal funds higher to the new range of 1.25% to 1.5%. So, granted, that doesn't sound like a big shift, but keep in mind that as recent as just 2 years ago, rates were at zero, so right. Definitely heading in an upward direction. Keep in mind, too, that the Fed doesn't exactly set interest rates. They give this Fed funds rate, which is guidance. The markets and banks tend to follow suit. So we should see rates trending higher in the coming weeks and months, and really this is good news. This says that the Fed sees strength in the economy. Remember that they tend to guide rates higher when the economy is doing well, as opposed to trying to push them lower when the economy is struggling. And so we can interpret this as good news for the economy. Also, the fact that this is the third time this year that the Fed has bumped rates. So contrast that to just once last year and just once in 15. So really they see this strength picking up, and so the momentum of their increases picks up as well.
So one of the reasons everyone is saying the economy is doing well is because of the strength in the stock market.
Sure.
So what will this change, though, mean to the stock market?
Sure. So the good news is, at least in the here and now, it was a non-event for the market. We've seen in the past that the Fed sometimes has the ability to give the market a surprise, and that can cause strong movement one way or the other. This time around, there were no surprises. This is something that had been very widely anticipated, so it was almost a non-event for the stock market. For consumers, on the other hand, I think we'll see some changes coming in weeks and months as we look forward. Again, banks tend to follow that Fed guidance, and so if you are a borrower, you'll probably see higher rates on loans and mortgages. If you're a saver, you'll see higher rates on things such as savings accounts. But again, it's only 0.25 percentage point, so it's not going to be a huge change.
So there were three hikes this year. Right. What should we be looking for coming up next year?
Sure, and that's a great question, because it's always very important to be anticipatory of what the Fed's going to do. Remember, surprises are bad. And so the Fed was pretty clear on Wednesday that they anticipate raising rates another 3 times in 2018. So that really continues this momentum of increased rate hikes. And so I think the market would be wise to take them at their word, with one big caveat, and that is that Janet Yellen, the current Fed chairperson, will be stepping down in February. And so as there's that transition to the new chairperson, hopefully smooth, hopefully just a continuation of the status quo. The market would like that. Again, no surprises, please. But we'll have to see, how things play out.
Great. Well, thank you. This is great information, and we'll see what happens next year.
Absolutely.